GoviEx Uranium. Development projects, Africa focused. Just for direction, that is our Nigerian project. One of the key benefits, as I would point out, it has no environment. We're right in the middle of the desert, but have infrastructure, have water, have people. They just, thankfully, are not on top of the project and are all well off it. But just gives you a sense of the type of environment we deal with. Cautionary statements, forward-looking statements, they're all on our website. So let's go through the company. We are a development-focused company. We've been around since 2007. We have two main projects, the Madaouela Project in Niger. It's fully mine permitted. It has completed its feasibility study. It's on the debt financing route at the moment. The Muntanga Project, mine permitted, currently working through its feasibility study to get onto that debt line to get into construction. These are long life projects producing about 2.6 million pounds per annum. We see a much strengthening market in the uranium sector. Every bit of news that you see out there now is pro-nuclear. If you were looking at this 2-3 years ago, we were still in the anti-nuclear. There's been a complete realization through high energy costs, through what's happening in the Ukraine. The nuclear has got to be part of the way forward. Development of the SMRs are happening a lot faster as well. We need more uranium, but we need higher prices to get there. There aren't enough projects on the table at the moment. Why Africa? Because you get projects done. Permitting in Niger was 4 months from start to finish. And we have a very large resource, but we stopped drilling back in 2013 because we already had long life projects, a lot of exploration upside on what we've got. As I say, Africa is where we like to be. Namibia and Niger are the 4th and 5th largest uranium producing countries in the world. There is a massive uranium belt that goes all the way from Tanzania through Namibia, through South Africa, called the Karoo. Massively underexplored going forward. Niger has been producing uranium since the early 70s. It's a well-trodden path, well understood. All of the major converters have taken Nigerian material. Why do we like the market? I'll touch on this very briefly, but yes, you are now looking at 190 million pounds of uranium demanded every year, increasingly so. Only 130 million pounds is being physically mined out of the ground. That gap has historically been filled by inventory drawdown, but the last UX report on inventory basically says there is no fungible uranium left, guys. Everybody who's got inventory wants to keep their inventory because they need it. The other part was the secondary market that was heavily coming from underfed material coming out of Russia. That material is no longer available because it's been sanctioned out, involuntary or voluntary sanctioning coming through. You're actually getting the opposite problem. Urenco is now trying to fill that gap. Urenco can only do that one way, and that is to overfeed its enrichment capacity, which means it is taking a higher tails grade. It is inefficiently converting uranium into enriched product, so it's pulling down. That's causing another problem. We're running out of UF6, so we're having to be inefficient there. So the gap was being filled. You don't have enough production. The gap is no longer there to be filled. Market has to respond. Spot price has not really moved, but it's really because the utilities have been worrying about where the EUP comes from. That material they need within 6 months to make a fuel rod. U308, it's 2 years, who cares? I can wait. But when you need UP, you need it now. You need to know when it's turning up because you've got a big reload coming. That's what they've been focused on, and they're still worrying about it. As soon as that comes through, and that's why the spot market's been so quiet, this market's going to turn very quickly as they revert back into the spot market or the term contract market looking to get material. So where does that leave GoviEx? Madaouela. Infrastructure is great on this project. We're next to the old Orano mines. We've got a lot of water, as I said. We've got people that have been trained and learned how to mine uranium for the last 50 years. We've got the government supporting us with a 20% stake. We're targeting 2025, end of 2025, early 2026 to get this project up and going. We put our feasibility study out at the end of last year, beginning of the 3rd quarter. Pretty well the peak of the inflation cycle. Good timing for us. But we've gone through a lot of the ESG aspects here. We've put in the renewables. We've worked on reducing our power demand. We've worked on reducing our water consumption. We're designing this mine to 100% local employment and gender balanced as well. These are all aspects that may be simple, but at the end of the day, that's what the banks want to see to lend you money, and that's what the off-takers increasingly are demanding. You cannot ignore ESG in this industry or any industry now. You've got to be thinking about it as a management team when you build your projects. So Madaouela's done. It's a very long life project. It's full MPV and doesn't really get to be seen. It has a steady $83 million of EBITDA for 20 years. It's all about the cash flow for us now in the first 5 to 8 years to get that debt, to pull through, to finance it. That's what we're working on at the moment. We've got 20 lenders currently in the data room going through that process to weed them down to the core syndicate, which will probably happen in the next 6 months. We'll then come out on the offtake side to pin that down and then be looking for the equity side. So target, get all that done this year, get into the construction phase. Most people forget though, we have another project. Everyone looks at Madaouela. We've got Muntanga. It's a really robust project. In fact, from an MPV and IRR point of view, it's actually better than Madaouela. It's very simple, open pit, heap leaching operation in a country that produces acid. And for benchmark of low acid, this consumes less than 10 kg a ton of rock. To benchmark that for Cominac and Somaya, 120 kg a ton. For Madaouela, 50. Country produces acid. It's trying to get rid of it all of the time. So that one now, we did the infill drilling, looking to do the resource statement update on the Dibwe East deposit. It's about half of the total resource. We're now doing the upgrade work on a metallurgy. Target is that by this time next year, this will have reached its feasibility study as well. We'll then be looking to get into construction for our second uranium project. Again, something that's different for Madaouela, we have a pipeline. Most people have one project. In fact, if you look at a lot of the companies out there who are listed with projects, they're all short life projects. That's a difficulty if you want to contract. You need long life projects to get contracts. I said ESG is key. We put our first ESG report out in September last year with the Onion system. Really important because it's actually driven by all of the ESG funds. Uranium, nuclear is part of clean energy. It's targeted for ESG funds. So very much part of it. We've built that through. But also ESG is more than that. It's about getting your team ready for construction, building the culture, getting the process ready that when you go from being an explorer to being a constructor, to being a builder, that team culturally changes itself. It morphs itself, it grows. That's what ESG is about. It's not just about solar panels. It's about more than that. It's about getting your team ready to build. We have the Falea Project. This is a really interesting project. I reference it because we still own it today, but we have agreed to sell it. It was always our third project. We've agreed to sell it to a company called Africa Energy. Deal still has to close. We always had to have it on the back of the line from a budget point of view. They are making it their number one project. They will push it a lot harder than we could. We don't have to finance it anymore, which means I can pull down on my dilution. More importantly, though, we still end up between about a 30 and 40% shareholder of them after the deal with a 3% NSR. So we still get all the upside, but we don't have to keep financing it going forward. So it's a good deal for us, allows us to focus on our core projects. Insiders are sitting just under 12%. Denison Mines are sitting there. Of the other shareholders, about 50-50 retail to funds. Trades well, it's well over 1 million shares a day. Trades both on the OTC and the TSX-V. But really the valuation we've got out there is ridiculous. It is so cheap. It doesn't justify where there is one company out there with a project ready to start, 8 years life, needs a higher price to get going than us. It trades at $4.30 a pound in the ground. We got 2 projects that get away quicker than that. They're bigger, they're longer life. This doesn't make any sense. So there's a real value add here, guys. We always say, in the previous cycles, 2004, developers to producers got the real rate and made you the money. Think Paladin, think Energy Fuels. In the last cycle, it was the takeout. Most of those takeouts were African projects. China cannot buy uranium from Canada. It cannot buy uranium from Australia. It can buy uranium from Africa. Second largest uranium buyer in the world happens to be CNNC, and it's going to get bigger. So We like the market. We are a development management. We've been doing this for a while. We got our permits. We're driving towards construction and building. Thank you.